Were you aware that following the split, the price of Tesla stock may be quite high? Although many are looking forward to the 3-for-1 stock split, analysts say that investors are not particularly excited about the price objectives for the EV company's stock. As the name of this Tesla grows more and more well known every day, keep checking back for more information. When Tesla revealed its intention to divide its stock 3-for-1, it created a stir. The debate over whether Tesla is overvalued or undervalued is taking place in the midst of this. While the goal of the stock split is to increase availability for Tesla employees, there are those who believe that following the split, Tesla's stock price might potentially soar. You'll learn why analysts are disclosing alarming price expectations for Tesla shares following the split in today's video. Tesla provided more details about its intentions for the August 4, 2022 annual stockholders meeting in a 14A filing with the SEC. Tesla announced its plans to split its common stock in a 3-for-1 ratio in the 14A filing, along with a number of agenda items. This will triple the number of shares available and divide the price by 1/3 on the day the stock split occurs. This action only makes more common shares of a publicly traded company available while lowering the price to make shares more accessible for investors. It has no effect on the firm's valuation. According to Tesla, the company's board of directors decided to split the company's common stock 3-for-1, which essentially implies that you will receive 2 extra shares for every Tesla share you currently own. They claim that this action will increase the availability of Tesla stock ownership for both investors and employees. We want to make sure all employees, no matter when they join, have access to the same advantages. The paperwork stated we believe the stock split would help reset the market price of our common stock so that our employees will have more flexibility in managing their equity. In case you are having trouble understanding the idea, stock split occurs when the board of directors of a firm provides more shares of stock to its existing shareholders without reducing the value of their equities. As per Forbes, the stock split reduces the value of each share individually while increasing the number of shares in circulation. This cosmetic split of the shares may indicate that smaller investors believe they may purchase the stock, despite the fact that their numbers pale in comparison to those of major institutions. Stock splits, however, have no effect on a company's worth. For instance, when a corporation with a $100 stock price splits its shares into 2 for $1, its owners will end up with 2 $50 stocks each. Their previous single share was worth the same as the value of their 2 new shares. After stock split, corporations often outperform the CFP 500, with a typical 3-month period following the split going up by roughly 2.1%. After 6 months, companies typically move 7.8%. The SEV 100 moves 4.4%. A split stock moves 13.9%. And after a year, the CV 500 moves 9.1%. And the split stock moves 25.4%. Stock splits frequently have an impact on a company's profitability because fractional shares make the stock appear more affordable or easier to purchase. Though prospective investors might benefit from the split, what impact will it have on existing stockholders? The financial stake held by current Tesla investors will remain unchanged. Should the motion be approved by stockholders, their shareholding will increase by 3 times. Is the price of Tesla stock too high or too low? In your opinion, post your ideas in the space provided for comments below. The major justification for this kind of stock split is to have a favorable psychological effect on investors. A rising share price can make it appear unaffordable. Conversely, a falling share price can be interpreted as a worse investment even if the company's market capitalization remains unchanged. The affordability of shares could rise as a result of a stock split exit. It may attract to investors who might not have otherwise selected a certain stock because of what is thought to be a more affordable stock price. A draw like that might increase demand and eventually raise the price of the stock. In the meantime, Barclays is increasing their price target on Tesla in the face of multiple problems that have hindered the company's manufacturing, primarily because of China's zero COVID policy that imposed a lockdown. Barclays is a global bank based in the United Kingdom that functions through 2 divisions, Barclays UK and Barclays International. Barclays Execution Services is the firm's service provider. It is well known for being a significant worldwide provider of financial services, including wealth management, corporate and investment banking, credit cards, and retail banking. Once more, Barclays is increasing its price target by 14 for the top EV. This implies that Q2 production will probably total roughly 256,000 Even if Elon Musk, the CEO of Tesla, is aiming for 300,000 deliveries, a delivery of only 256,000 would be the biggest drop in Tesla's history. Others, however, might find it understandable given that this was partly brought on by the previously mentioned China lockout, which also disrupted the Shanghai factory and caused problems with the supply chain, making it take longer for the company to reopen. Additionally, ABUS increased its price objective, creating a significant order backlog and significant margin momentum. With operations in more than 50 nations, ABUS Group AG is a global investment bank and provider of financial services. They continue to project a 50 annual increase. With an $1,100 price goal, they are more likely to take an annual rather than a quarterly approach. Additionally, they anticipate that Tesla's better growth and profitability will come from its vertical integration of semiconductors, software, and batteries. Furthermore, they think that because Tesla owns its own battery plants, construction, and production, the firm is ideally positioned to generate better margins with its batteries being the main bottleneck for the electric vehicle market. In fact, UBS is so confident in its bull case scenario that they believe Tesla can achieve a very bullish gross margin of 34.7, up from 30 where they are now sitting without tax credits. With an increased buy rating, UBS now believes there is over 50 further upside. For the electric car company shares, what are the reasons why Tesla stock could rise following the split? First, increased production leads to more car deliveries. It's no secret that production limitations have made it difficult for Tesla to match prior demand for its cars. In actuality, the company's rapid expansion has been impeded by a shortage of production space. But with the opening of 2 brand new gigafactories, one in Berlin, Germany, and the other close to Austin, Texas, that might be about to change. With the latest additions, Tesla's annual car production capacity will increase from 1.5 million to 2 million to 2 million. Nevertheless, the business must deal with supply chain problems for components like semiconductors and raw materials, a challenge that all automakers are currently encountering. Second, a larger gross margin is the result of more deliveries. A company's revenues less its cost of products is its gross profit margin. For Tesla, the automotive gross margin is calculated as the car's price minus the direct manufacturing costs. It would involve expenses like as the raw materials needed to construct each car, but since those are operating costs, they wouldn't include marketing or the money spent on Radrasty. Due to a phenomenon called scale, Tesla's gross margin rises as it produces more vehicles. Tesla would lose money if it constructed a factory with the capacity to make 500,000 cars but only produce 50,000, as it would be paying for the additional capacity without really using it. But its fixed expenses are as low as possible as a percentage of its revenue when it produces all 500,000 cars, increasing its gross margin. Due to the company's record-breaking car deliveries, Tesla's gross margin has steadily increased and is currently at its highest point in the history of the business. Lastly, a larger net income is correlated with a bigger gross margin. Simply said, net income represents the company's profit margin and is a number that most investors pay close attention to. It's significant because it converts to earnings per share when divided by the total number of shares in circulation. Many analysts projected that Tesla would never turn a profit due to the high cost and difficulty of manufacturing automobiles. Only about 15 of the finest automakers, like Ford Motor Company, are able to achieve a gross profit margin. However, Tesla has created industry-leading procedures for building electric cars, and the end product's high quality justifies premium cost. With a gross margin of 32.9, Tesla has much more room for operating investments, such as the creation of novel software innovations like autonomous driving and the design of new goods, which can help the business stay ahead of its rivals. More significantly, though, is that a high margin increases revenue to the bottom line. Tesla made nearly $3 billion in net income in just the first quarter of 2022. For more of this stuff, check out Tesla stock and our other films.